You've seen the headlines. Some stock market guru timed everything perfectly, made a fortune overnight, and now they're selling you their secret. You see the complicated charts, you hear the baffling jargon, and you're left thinking that winning in the market is reserved for a select few. But what if I told you that following that kind of advice is probably the very thing sabotaging your portfolio? It's true. Millions of investors, even the pros, are led astray by popular myths. They chase hot stocks, they overcomplicate things, and they second-guess every decision, while the real, almost boring drivers of wealth get completely ignored. Today, we're going to dismantle the biggest lies about stock market success. We're going to show you why things like market timing are a trap, and give you the simple, evidence-backed truths that will actually build your wealth for the long haul. It's time to tune out the noise and focus on what really works. But first, a quick and important disclaimer. I am not a licensed financial advisor. This video is for educational purposes only. Myth 1. You can reliably time the market. Alright, let's kick things off with the biggest, most tempting myth of them all. The idea that you can reliably time the market. This is the ultimate investing fantasy, right? The dream of buying at the absolute bottom and selling at the absolute top. The media adores this story. We hear about the genius trader who predicted a crash, or the one who jumped in seconds before a massive rally. It feels like the smartest way to invest because if you could pull it off, the returns would be astronomical. This myth is so powerful because it plays right into our desire for control. We want to believe we can outsmart the system, that with just enough research or the right secret indicator, we can dodge the downturns and catch all of the waves. It's an intoxicating thought. But here's the cold, hard truth. Consistently timing the market is practically impossible. The real problem is you have to be right twice. You have to know the perfect moment to sell and the perfect moment to jump back in. And here's the kicker. The market's best days often happen right next to its worst days. Research has shown that missing just the 10 best days in the market over a 20-year period can slash your returns by more than half. Think about that. Just 10 days out of thousands can be the difference between incredible wealth and a portfolio that goes nowhere. So what do? You stop trying to time the market and instead focus on time in the market. Long-term, patient investing is the undisputed champion. Instead of guessing, use a strategy like dollar-cost averaging, where you invest a fixed amount of money at regular intervals. This takes the emotion out of it and smooths out your purchase price over time. History shows that markets trend upward in the long run, and the people who are rewarded are the ones who have the patience to stick around for the ride. Myth 2. Complex strategies outperform simpler ones. This next myth feeds on our insecurities. The belief that to get truly exceptional returns, you need some kind of wildly complex strategy. You know, the stuff that sounds like it was cooked up in a mad scientist's lab. Intricate options trades, algorithmic signals, or quantitative models that only a math genius could understand. The financial industry often perpetuates this, making investing feel like it's a club for insiders only. And it's easy to believe because complexity feels authoritative. When someone starts throwing around fancy jargon and pointing at bewildering charts, it's easy to assume they know something you don't. We fall victim to what's called complexity bias. Our brain's tendency to think a complicated solution must be better than a simple one. This leads people to dismiss a simple buy and hold strategy as too basic to possibly work. Yet, the evidence overwhelmingly shows that complexity doesn't just fail to guarantee better returns. It often leads to worse ones. Complicated strategies usually lead to overtrading, which racks up fees and taxes, and they dramatically increase the odds of making a huge mistake. Even the investing legends preach simplicity. They focus on one thing: understanding a business and holding it for the long term, not building some indecipherable trading machine. The key takeaway here is that discipline and emotional fortitude are way more important than how complicated your strategy is. For the vast majority of us, a simple, low-cost, diversified approach is the most effective path to building wealth. This can be as straightforward as regularly investing in a broad market index fund. You don't have to be a Wall Street quant. You just need to own a slice of the entire market and let time do the heavy lifting. In investing, the simplest solution is usually the most powerful. By the way, if you're finding this myth-busting helpful and it's cutting through some of the financial noise for you, do me a quick favor and hit that like button. It's a huge help for the channel and tells me I'm making stuff that you actually find useful. Myth 3. Value investing is dead. This myth has been getting a lot of airtime over the last decade. With the explosive rise of high-flying tech companies, many investors have started to believe that value investing, the classic strategy of buying stocks for less than they're actually worth, is an outdated relic. When you see growth stocks posting insane returns, it's easy to think that old-school, fundamentals-based investing just can't keep up anymore. And that feeling is totally understandable. The headlines have been dominated by a handful of giant growth stocks, making it feel like that's the only game in town. Watching those stocks shoot for the moon, while value stocks seem to lag behind, can test anyone's patience. But declaring value investing dead is a classic case of recency bias. We're letting what happened recently cloud our long-term judgment. While growth stocks have had an incredible run, history shows that value investing has a long and successful track record of outperformance. This is especially true during periods of economic uncertainty. In fact, after long periods where growth stocks get incredibly expensive compared to value stocks, like right now, value has historically come roaring back. The bottom line? Valuation always matters in the long run. A truly strong portfolio isn't about choosing either or. It's not growth versus value. It's about balance. A portfolio that holds both is far more resilient. Don't ditch a time-tested strategy just because it's been out of fashion for a few years. Markets move in cycles, and by owning a bit of everything, you're prepared no matter which way the wind is blowing. Myth 4. You must own the Magnificent 7 to succeed. This is the 2020s version of the last myth. The idea is that all the market's gains are coming from a handful of mega-cap tech stocks, and if you aren't piled into them, you're doomed to fail. The media's obsessive coverage of the Magnificent 7 creates a massive sense of FOMO, the fear of missing out, making investors feel like they're being foolish for diversifying. The proof seems to be in the pudding. In 2023, these 7 companies were responsible for the vast majority of the S&P 500's gains, with some of the individual stocks soaring over 100%. The group as a whole collectively climbed over 75%. Without them, the index's overall return would have been pretty mediocre. When you see numbers like that, it's incredibly tempting to just throw all your money at those few winners. But this thinking is dangerously short-sighted. Piling your entire portfolio into just a few stocks, no matter how amazing the companies seem, is the exact opposite of smart risk management. While these stocks crushed it in 2023, let's not forget that the tech sector as a whole got hammered in 2022. Today's magnificent winner can easily be tomorrow's loser. The names at the top of the market are constantly changing. So here's the principle that never goes out of style. Diversification is the only free lunch in investing. A concentrated portfolio might give you a thrilling ride for a year, but it's far more likely to leave you stranded over the long run. You're exposed to catastrophic risk if one of those golden companies stumbles. The goal isn't to capture 100% of the latest trend. It's to build resilient, long-term wealth that can survive anything the market throws at it. A diversified portfolio is built for every season, not just the sunny ones. Myth 5. Switching managers will boost your returns. Our final myth is all about finding someone to blame when things aren't going perfectly. It's the belief that if your portfolio is underperforming, the problem must be your financial advisor or your investment firm. And the obvious solution, of course, is to fire them and find a better manager who can work magic. It's easy to fall for this because it offers a simple fix to a complex problem. It feels proactive to fire an underperformer and hire someone new who talks a big game. You feel like you're taking control and fixing the issue. But here's the reality. In most cases, your returns aren't determined by the genius of your manager, but by your asset allocation. Decades of academic research have shown that your asset allocation, how your money is split between different investments like stocks, bonds, and cash, is responsible for about 90% of your portfolio's returns over time. Most financial advisors have access to the exact same investment products. The difference in performance from one portfolio to another is rarely due to a manager's secret sauce. It's the recipe, the underlying asset mix, that truly matters. So before you go through the hassle of switching advisors, look under the hood at your own plan. Is your asset allocation truly aligned with your long-term goals and your risk tolerance? That is the single most important decision you'll make. A great advisor is there to help you build that plan and, crucially, help you stick with it. But don't fall for the trap of thinking that just swapping out the captain will magically get you to your destination faster. Your portfolio's success starts and ends with your strategy. So, let's put these myths to bed once and for all. First, you can't time the market. Patient time in the market is what builds wealth. Second, complex strategies aren't better. Simplicity and discipline almost always win. Third, value investing isn't dead. It's a vital part of a resilient portfolio. Fourth, you don't need to chase a few hot stocks. Diversification is your best defense. And finally, stop blaming the manager. Your asset allocation is what truly drives your results. Real, lasting success in the stock market isn't about secret formulas or crystal balls. It's about building a solid plan on proven principles, keeping your emotions in check, and having the patience to let that plan do its work. By simply avoiding these myths, you are already miles ahead of most investors out there. If this video helped clear things up for you, please subscribe and hit the notification bell. That way, you won't miss future videos designed to make you a smarter, more confident investor. And check out this other video I made on building a simple 3-fund portfolio. I think you'll find it incredibly valuable. Thanks for watching.